Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. It may not seem like it today, but Rivian is really walking a tightrope with its cash situation. The company is burning money from current operations as it tries to ramp up production of its R1 and EDV vehicles, and then it's also spending a lot of time and energy building out a production facility in Georgia that could cost $5 billion to build the R2 line of vehicles. Can it do all of these things without offering more debt or selling shares? I don't think that there's enough cash on the balance sheet to do that, but I want to walk through the numbers here today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you enjoy this video, check out my newsletter, Asymmetric Investing, in the show notes. Let's go to the most recent result and show just where cash burn is coming from. This is the income statement side of things for Rivian. And you can see that each vehicle, they're losing about $33,000. That is down significantly from a year ago when each vehicle was losing about $160,000. And that will continue to improve as they optimize production, produce more vehicles, and spread fixed costs across more vehicles. And given this trajectory, we could see break even on a gross profit level maybe by the end of 2024. I think that's a reasonable expectation. But even if they're break even on a gross profit level, you're still spending a lot of money on R&D and SG&A. Again, those costs have come down. But if we just assume that those operating expenses are about $800 million on an ongoing basis, that's still $3.2 billion per year in operating costs on top of, at best, a business that's gross margin break even. So right now, for the most recent quarter, we saw $1.4 billion worth of cash used from operating activities. That's on top of capital expenditures, which would be where costs for the Georgia plant would go. Let's assume that over the next 6 quarters, so through the end of 2024, Rivian can be break even on its vehicles and still spends about $800 million on operations. So cash burn from operations would be about $800 million. That's $4.8 billion that would be burned from operations, I think, in an optimistic scenario by the end of 2024. Now, on top of that, you have a $5 billion plant being built in Georgia. That's not going to be operational until 2026. So now we have nearly $10 billion in cash that's going to be burned building out that next facility and just running the business over the next 6 quarters. How much cash is on the balance sheet now? A little over $10 billion. So this is the precarious situation that Rivian is in. Cash burn is so big and so fast that it's using up a lot of this cash. And then they're trying to also build another facility that is going to take billions more in cash. On top of that, to make things even worse, the company has already taken out $2.7 billion worth of debt. So if you do need more cash to fund operations, you really have 2 options. You can sell stock or you can take out debt. Rivian has decided to take out debt recently, and that actually hamstrings their ability to take out debt in the future. So I think the best possibility would be selling more stock. That would be dilutive to current shareholders. But the reality is that given the pace of cash burn, even if we assume there's going to be a lot of improvements over the next 6 quarters, the company doesn't have a lot of room or a lot of extra money, may actually even run out of cash. So there's going to need to be some sort of capital raise likely in the future. The irony of companies that are growing in the physical space, manufacturing space, is that it's very expensive to grow your business. Not only do you have to build out that production plant, you often burn money as you ramp up production. And then we haven't even talked about inventory. The build out of inventory takes cash because you need raw materials, you need work in progress materials, and then you need finished goods to actually deliver to customers. And those customers aren't going to pay for a vehicle 6 months in advance. They're going to want to pay for it when they get it. Over the past 6 months alone, the increase in inventory has pulled $1.2 billion worth of cash off of Rivian's balance sheet. So that's another challenge that we didn't even talk about here. Rivian may actually be more of a tightrope than you think. It seems great to have over $10 billion worth of cash, but you have to consider how fast that cash is being used by operations, what plans are to build out new facilities in the future, and how much might be left over. How profitable is the business going to be when you reach some level of maturity? And we haven't seen Rivian even be able to produce its vehicles at a break-even point at this point. So I think a lot more concerns from a cash perspective and a balance sheet perspective than a lot of investors are giving Rivian credit for right now. Don't be surprised to see management selling stock over the next few months just to raise cash to try to get to that endpoint and get that Georgia facility up and running. But I think that's worth highlighting for investors. What do you think of the recent results? What do you think of Rivian's cash position? Love to hear your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.